Welcome back to the channel. I'm Algabot, and today we're taking an educational deep dive into a MetaTrader 5 expert advisor called the Adaptive Decay Impulse Breakout. This is an unusual strategy because it doesn't lean on any traditional indicator. Instead, it builds its own signal from raw price and volume, using a self-adjusting memory of market order flow. Over the next several minutes, we'll unpack how it measures momentum, how its memory speeds up and slows down with the market, and exactly when it decides to enter and exit a trade. Remember, this is educational information only, never financial advice. Let's get started. So what does this expert advisor actually do? At its heart, the Adaptive Decay Impulse Breakout treats every closed candle as a small injection of directional pressure into the market. It multiplies that candle's tick volume by its change in closing price, and it calls the result an order flow impulse. A big move on heavy participation produces a large impulse. A quiet drift produces a small one. The strategy then feeds these impulses into what engineers call a leaky integrator. Think of it as a running total that slowly forgets the past. Each new impulse is added on top, while the older accumulated value gently decays away over time. Here's the clever part. The rate at which that memory decays is not fixed. The strategy constantly compares short-term move volatility against long-term move volatility. When the market speeds up and volatility expands, the memory shortens, so old flow becomes stale quickly. When the market calms down, the memory lengthens and holds onto information longer. In other words, the accumulator forgets at a pace the market itself dictates. The strategy is looking for sustained, one-sided pressure that the opposing side has not yet absorbed. It doesn't want a single dramatic candle. It wants a genuine, building imbalance. To measure that, it wraps the accumulator in a rolling Z-score envelope, comparing the current value to its own recent average and spread. A signal is only considered when the accumulator pushes well outside that envelope and is still accelerating in the same direction. Everything about risk is self-computed from a rolling, true-range measure of volatility. Stop distance and target distance both scale with it, and position size scales inversely, so calmer regimes get slightly larger clips and choppier regimes get smaller ones. This approach is designed with liquid foreign exchange majors, like Euro versus US dollar, on an intraday time frame, such as the 15-minute chart in mind, though the symbol and time frame are always read from the platform at runtime. It's built for traders who enjoy understanding the machinery under the hood. And of course, like any strategy, it carries real risk, and losing trades are part of the picture. Let's walk through the mechanics step by step. The expert advisor only acts once per fully closed bar, using the candle that just finished. That no repaint rule matters, because it means signals don't flicker while a bar is still forming. For each closed bar, the strategy calculates its impulse by multiplying tick volume by the change in closing price. A positive impulse means buyers pushed the close higher. A negative impulse means sellers pushed it lower. That impulse is added into the leaky integrator, where the previous accumulated value is first multiplied by the adaptive decay factor called lambda. Lambda is computed by raising the DecayBase, which defaults to 0.9, to the power of the speed ratio, then clamping the result between 0.5 and 0.98. Speed is simply short window move volatility divided by long window move volatility. Once the accumulator is updated, the strategy measures how extreme it currently is. It takes a rolling average and standard deviation of the accumulator over the Z window, 60 bars by default, and converts the latest value into a Z-score. It also checks acceleration, meaning whether the accumulator is still increasing in magnitude compared to the previous bar. Now the entry condition. A long signal is registered when the Z-score climbs to or above the ZEntry threshold, which defaults to 1.5, while acceleration is positive and the accumulator itself is positive. A short signal is the mirror image. The Z-score drops to or below negative 1.5. Acceleration is negative, and the accumulator is negative. The acceleration filter is what separates a genuine escape from a tired, decelerating push that's simply sitting at an extreme. Exits are handled before any new entry. If a long position is open and the Z-score mean reverts back down through zero, the strategy reads that as the imbalance being absorbed and closes the trade. The same applies in reverse for shorts. And if a fresh, accelerating escape appears in the opposite direction, the strategy closes the current position and flips. Finally, protection. Stop distance is the stop multiplier times the rolling true range volatility, and target distance is the target multiplier times that same volatility. With defaults of 2 and 3, targets sit farther away than stops, giving a reward-to-risk shape of roughly 1.5 to 1. Position size scales inversely with volatility, within sensible limits. Every one of these numbers adapts to current conditions rather than being fixed in advance. Let's read through the meta editor code on screen. At the top are the input parameters you can adjust in the strategy tester. DecayBase and ZEntry shape the signal itself. DecayBase defaults to 0.9 and ZEntry to 1.5. Then you have the volatility windows, the short and long move volatility lengths of 10 and 50, the Z-envelope window of 60, and the price volatility window of 14. The stop and target multipliers default to 2 and 3, and lot sets the base volume. Now look at the two Boolean lines. The variable go-long is true when the z-score, written as z, is greater than or equal to ZEntry, and acceleration is positive, and the accumulator I is positive. In plain terms, the flow accumulator has escaped the upper edge of its envelope and is still building upward. The variable go short is the exact mirror, the z-score at or below negative ZEntry, acceleration negative, and the accumulator negative. Just below, stop distance and target distance are computed from sigma price, the rolling true range volatility, multiplied by their respective multipliers. In the long branch, the entry reads the ask price, the stop is placed at stop distance below entry, the target that target distance above, and the platform's trade dot by places the order. In the short branch, it reads the bid, the stop sits above entry, the target below, and trade dot sell submits the order. Both sides carry the same strategy comment, and both attach protective stops and targets at the moment the order is sent. Educational only, of course. Let's bring this to life on the chart. Up top you can see the candles, and in the panel beneath them we're plotting the strategy's own homemade signal, the accumulator z-score. Watch how it relates to the dashed lines. The upper envelope at positive 1.5, the lower envelope at negative 1.5, and the mean at 0 right in the middle. The green shaded band above is what the strategy calls a bullish escape, and the red band below is a bearish escape. Look at the first couple of candles on the left. Price is drifting sideways in a quiet stretch, and the z-score sits close to 0. There's no meaningful imbalance yet, so the strategy simply waits and keeps accumulating information. By the third candle, buyers step in with a solid green push on healthy volume. Each of those closes adds a positive impulse into the leaky integrator, and you can see the z-score climbing quickly from below 1 up through the upper envelope. This is the moment the long condition is satisfied. The accumulator has escaped above positive 1.5, and critically, it is still accelerating upward, meaning the imbalance is building rather than fading. That's the buy entry marker you see on the chart. The stop is placed below, at a distance set by the true range volatility, and the take-profit target is placed farther above, giving that reward-to-risk shape of about 1.5 to 1. Now follow price forward. The next two candles extend the advance, closing higher and higher, while the z-score presses deeper into the bullish escape zone. Price reaches the take-profit target, and the long trade is booked at the take-profit marker. Notice that even if it hadn't reached the target, the strategy would have looked to exit once the z-score mean reverted back down through 0. Reading that as the buying imbalance being absorbed. After the top, momentum shifts. Around the 8th candle, the z-score falls back through 0, and then sellers take control with a firm red candle. Impulses turn negative, the accumulator swings down hard, and the z-score plunges through the lower envelope at negative 1.5. Acceleration is now negative and the accumulator is negative, so the short condition is met. That's the sell entry marker. Here the stop sits above the entry and the target sits below, again scaled by volatility. From there, price works steadily lower, candle after candle making fresh lows, while the z-score holds inside the bearish escape band. Price finally reaches the downside take-profit target, and the short trade closes at the second take-profit marker. So across this single illustration, you've watched both halves of the strategy, a long that formed when flow escaped upward while accelerating, and a short that formed when flow escaped downward while accelerating, each protected by an adaptive stop and target. This is a simplified teaching example, and in live conditions, plenty of signals don't reach their targets at all. And that brings us to the end of our look at the Adaptive Decay Impulse Breakout. We saw how it turns raw price and tick volume into an order flow impulse, how it accumulates that flow in a leaky integrator with a decay rate that adapts to market speed, and how it only acts when the accumulator escapes its own z-score envelope while still accelerating. We also covered its adaptive stops, targets, and position sizing. Everything here is for educational purposes only, and it is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy carries real risk, and losses are part of trading. If you found this breakdown helpful, please like the video, leave a comment with strategies you'd like explained next, and subscribe for more MetaTrader 5 analysis. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.